It seems obvious that safety is a #1 determinant for auto purchases, but could this really mean that Tesla has an even better chance of stealing some of the market share from others like a BMW or Mercedes or even a GM when it goes live with the Model 3?
We do think it's an opportunity, and vehicle safety is even getting more attention in social media and from regulators because of the spike in fatalities, up almost 20% in this country over the past 2 years. Melissa and Brian, it seems like the only thing progressing faster than the pace of machine learning is the pace of human unlearning, okay? I mean, we're getting dumber faster than the cars are getting smarter, and a lot of it is this, of course. NHTSA refers to it as distracted driving. From a Tesla perspective, they're putting a liquid-cooled supercomputer in every car, okay? And we don't think they're putting a liquid-cooled supercomputer in every car just to make these vehicles twice as safe. Elon himself had tweeted a little while back of the goal of making the cars 90% safer or 10 times as safe. If they're anywhere close to that, Melissa and Brian, we think the rest of the auto industry and the regulators and NHTSA and Congress is going to have to kind of pay attention to that. We think consumers certainly will.
Yeah, you know, Elon recently tweeted out video of the Model 3. What's your take on the vehicle and given your outlook on safety and how safe the Model 3 could be on your outlook of Tesla hitting its forecast, most notably by 2018, 430,000 Model 3s? So,
you know, as we discussed on your program before, we think that Tesla is morphing into more of a transportation company, using vehicle machines sold today as kind of a funding strategy to become something much, much bigger, to not tapping into hundreds of thousands or millions of cars, but more billions, hundreds of billions of miles, and then the 600 billion hours that humanity spends inside cars. That's the real prize. So we've been pretty vocal. We don't think they're going to make those targets are too aggressive. We don't think we're not saying they're impossible, Melissa, those 2018 targets. We just don't have them there. Where we do have them, though, is doubling their 5 million miles a day to about 10 million miles about 18 months from now, becoming and then launching a transportation as a service.
In other words, so that their autonomous drive could be more intelligent, so to speak.
Even if they are human, Melissa, even if you're driving these cars with a steering wheel and you have your hands on the wheel, the car is just watching. It's learning. They put that $8,000 of equipment in there just so it can watch what you do well, watch what you don't do well, so it can train the network.
But if you're a terrible driver, you don't want the Tesla learning from that. I mean, this be
you do
clear.
Want them. Actually, Brian, I'm going to say it. Brian, you're right. Well, you're kind of right. They do want to watch the bad driver. They want to watch the drunk driver. They want to watch the good driver. They want to watch the kid jumping in front of the car.
Yeah,
they want all that.
Hopefully nobody drunk is getting behind the wheel, but I get your point, Adam. Let's move on very quickly. Listen, the electric car market in the United States is still less than 1% of cars out there. In fact, we're lower than Estonia in electric car adoption. But that says two things. It says, wow, what a big market for electric cars there is. Or, you know what? Maybe people just don't want to drive electric cars because they're still third cars for rich people. What's the answer?
Well, we think that electric cars for private use really are very, like, it's exquisite, or vehicles for human driving pleasure, okay, for wealthier individuals. That's why it's so important that in the shared model, where you're not driving 10,000 miles a year, but 50 or 100 in a fleet operation, then the economics of electrification, you can get that payback period to under 3 years. That's the game changer. Shared.
Adam, you've written in the past month or so about sort of the pitfalls, so to speak, of the exposure to the auto leasing market, the OEMs like a Ford, et cetera. When it comes to Tesla, I know the storyline's a little bit different because there's not necessarily a used car market for Tesla for which new cars pricing will be pressured. But in terms of the financing arm of Tesla, could it feel the pressure of rising interest rates? I mean, the Tesla loans are very generous. They're very generous terms.
Well, Melissa, our work on the used car values is more focuses on the obsolescence, the technological obsolescence of the 255 million cars on the road, the $2 trillion worth of cars in the United States. Tesla's cars can get better because they can learn. They put in that equipment so that the vehicle 5 years from now is much more superhuman and much better than the one that's just learning and watching right now. So the tip of the thrust of our used car thesis is that in a 5-year period, we're running scenarios of used values being off by as much as 50%. So we are telling our clients at Morgan Stanley, please, we are warning you, please be careful. There are implications across the capital stack and across the sector stack on obsolescence, and we think it's progressing. It is unprecedented, and we think it's going to make, we think in 3 to 4 years, there's going to have to be a policy response because there's going to be some problems in the market, we think.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.